store over the next 20 minutes or so. Dr. Chava, good having you. Thanks for joining in.
Good morning, Dennis. Nice talking to you.
Likewise, sir. Just start off with Q4. You had told me not once, not twice, that Q4 of this year would be similar to Q4 of the last year. On the revenue front, it's largely been the same. Good going on that. EBITDA margins too, I thought the highest in the last 3 quarters in a scenario like this is a pretty strong showing. Is it the scale? Is it the inventories? Or is it that your input costs didn't get impacted too much that helps you do that on the EBITDA front? And of course, comment on the top line growth as well.
When it comes to the top line, there was a revival in ARV APIs. That's the reason we were able to get back to normal revenue similar to Q4 FY21. But you might have seen our CDMO revenues were almost doubled when compared to the Q4 FY21 to Q4 FY20. The margins were less when compared to the Q4 FY21. The reason the solvent prices went up significantly. The power and fuel prices went up. And especially in the ARV, APIs and formulations, there was a stress on the pricing as well. And there is a change in product mix. So all these culminated to have little lower EBITDA margin. When I'm saying little lower, we're always guiding. We are very comfortable to achieve closer to 30% EBITDA. And if you look at the overall year, we are at 29%. Whereas for the Q4, we did only 28%. But in the coming quarters, we will catch up and then move closer to 30% EBITDA in the coming quarters.
Actually, Dr. Chava, I thought you did a fairly commendable job on the EBITDA front, considering the kind of pressures that exist around. So my question to you was actually that: is it that the inventory helps you? Is it that you're enjoying higher pricing powers? Because as you said, solvent prices went up quite considerably. So are you happy that with the EBITDA levels that you've done, or do you believe there was some room for improvement and which will get shown in the subsequent quarters? Or will that be a factor of just raw material prices going down? That's the larger question, really.
See, we don't expect the raw material prices softening in at least coming quarter, that is Q1 FY20. The reason why we are confident that we'll improve the margins from 28% Q4 to closer to 30%. The reason, not because we will increase the price, there is a change in the product mix. We anticipate further when compared to Q4 to Q1. The reason, the contribution coming from ARVs will come down. So the way there is a challenge is on the pricing of both ARV, APIs and formulations will come down. Then the non-ARV business in APIs, in formulations, and also in CDMO will help to weather the challenge posed by the increased pricing, raw material pricing and other cost escalations by non-ARV business. That's the main reason why we are very comfortable to improve the margins. Not just because of raw material prices will go down and we're able to increase the ARV prices. That's not the reason where we are comfortable to say improvement is possible from the Q4 to coming quarters.
Okay, so tell me this then, therefore, Dr. Chava, that if indeed there is some resolution or some improvement in the input cost prices, then you reckon you can do better than what you are thinking about right now, which is the 30% as well, in a particular quarter, maybe not necessarily over the quarters, but even that could happen.
A lot of imagination we need to do, but as our base becoming bigger, 1% is $4 or $5 million improvement, or even larger. So we still want to hold to our guidance of around 30%. So we may do 29, we may do 30, we may do 30. But we are saying closer to 30 is going to be reality, which we have done. The challenging FY22 also we were able to do at 29%. So I think we, if raw material prices ease as and then energy cost comes down, we may do better also. So, but we are not factoring all those to improve our margins. Our margins improve little bit from Q4 to further quarters because of a change in product mix.
Okay, fair call. Now I want to talk a bit about business growth, and I'll dig it up into two, Dr. Chava. First is the capacities which might allow you to do and the utilization levels, and then pure play business. I would love to understand about the environment with all that's happening between Russia, Europe, and all of that, and the whole China plus one thing as well, which has been there for a while. Firstly, on the capacities, you had mentioned to me that every year is not a step up year, but FY23 will be a step up year, and there need to be capacities that aid that, and some of these capacities will come on stream before March 2022. Now, can you tell us a bit about what are the expansion projects that have already commenced? What is it that could be about to get commenced in the next 3, 6, 9 odd months? And what happens to the utilization levels of some of these as they come on stream?
In the FY23 Q4, we qualified 2 large API manufacturing blocks, close to 1.5 million liters reactor. That's almost 20% what we had a year. So that capacity was online, right, in APIs. And we're also building more manufacturing facilities for APIs. In FY23, only 1 new production block will come online by October quarter. And we are investing more into APIs, but those will not be utilized in FY20. We are investing in creating greenfield as well as brownfield, except 1 new production line. Actually, 2 new production lines will be come online, 1 in Q2, 1 in Q3. So both put together again, it will be 1 million liters reactor. So that's a significant capacity. We're adding another 15% capacity in FY20. So that's in the API front. When it comes to the formulations, our capacity expansion brownfield, where another 5 billion units capacity will come available, fully qualified, trials completed in this quarter itself, where our new launches planned in Europe and US are Q3, Q4. So we are perfectly ready to take the opportunities available for us in both in Europe and US in formulations. When it comes to the other capacities, especially in the CDMO space, we started building greenfield projects. I don't think those greenfield projects will be qualified and put into commercial use this year. It will be for next year.
Okay. So a couple of follow-up questions. So there is nothing substantial that came on stream in that second half of FY22. Is there, sir?
Second half of FY22, we had significant capacity. 20% capacity was added in APIs.
Yes.
And again, in the second half of this year, June, Q2 and Q3, we're adding another 15% more API capacity.
Okay. And how do the capacity utilizations work out there? Also, can I also squeeze in that what would be the capacity utilization for the formulations capacity? Because I heard you mention that it comes on stream in Q1 and Q2 onwards, if I'm not wrong, you start seizing the opportunities in Europe. So give me some color on both of those.
In APIs, our capacity utilization is optimum. So it's quite normal to our previous years. We don't see any unutilized capacity right now. So if you had more capacity, we could have produced more. That's the way I foresee, right? When it comes to formulations, our previous capacity of around 5 billion is fully utilized now. So we don't have any spare capacity. So for us to grow, as we are saying, we need to reach $1 billion in sales. Either capacity is already created or will come into commercial use beginning from Q1 onwards. So except product approvals in Europe and US, 2 products in Europe and 2 products in US, which we don't have any regulatory challenges. We got the clear dates from the regulators. So capacity, product approval, we do believe all will be in place.
Okay, and therefore this formulation, the brownfield formulation capacity that comes on stream in Q1, you reckon the capacity utilization levels would ramp up quickly? It would ramp up quite quickly starting Q2 itself? Q3 onwards.
Q3.
Okay, so Q2 is kind of a testing phase. You wait for approvals, etc., and then Q3 onwards, the utilization levels go up. Okay, and therefore, I'm assuming that you reckon that this not aspirational but realistic target, in your words, of $1 billion by FY23 can be achieved with the capacities that you have, even if they don't go as high up on the capacity utilization levels as strongly as, I mean, there could be anomalies, right? It may not recently ramp up as quickly as you think, but you will still believe that you could reach that aspirational target by FY23.
See, the API capacity is what will come to commercial use during Q2 and Q3. We don't need these capacities to achieve our goal. Okay. These are the capacities we needed for FY24. And in the formulations, we need the capacity, brownfield expansion capacity is needed for us to deliver what we committed to our partner in Europe. So we need those capacities. And since these are brownfield, we don't see any regulatory. In fact, we are anticipating a European inspection in Q1. Once that is done, I don't see any challenge for us to utilize the brownfield FDF capacity expansion also.
Got it. Dr. Chava, just the fact that input costs have gone up so much for capacity expansion as well, you reckon the payback period and the overall cost for even the ongoing capacity expansion plans have gone up quite meaningfully? A lot of other companies in other sectors tell me that the payback period has extended itself quite significantly because of the higher input costs. Is your experience the same?
In the brownfield expansion, the payback period generally much faster than the greenfield facilities. So FY22 and FY23, most of our expansion happening in the brownfield. We saw the increase in capex because of the input cost went up, especially the steel and cement. But that's not going to derail our investment plans because of escalations. So there is a little longer period for payback, but I don't think that is going to change our investment plans.
Oh, no, I didn't mean that. I was just asking if indeed the payback does get extended. You do believe it does get extended a little bit?
Yes.
Okay. 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 Can I actually ask a couple of questions there and then get into business? You mentioned in the presentation as well that due to ongoing capex, in order to fortify yourself for future growth, your ROCs did take a hit. And now we're talking about the payback period also getting extended and substantial capacity expansions already underway. You're thinking of more as well. Do you reckon that, forget the erstwhile ROCs of 45%, but from the current 26%, do you stay at these levels for the foreseeable future? Or do we see some expansion in the return ratios starting FY23 itself?
I think initially when we were doing our strategy, we wanted to achieve 2 things. 3 golden 25s we used to call. Revenue growth 25%, EBITDA 25%, and the ROCE 25%. In FY21, we did achieve all those 3. In FY22, we did achieve 2 of those 3. We didn't achieve 25% growth, but we did maintain margins well above 25, EBITDA margins, and also return ratios also well above 25. But in FY23, we will definitely achieve all those 3. Maybe our growth will be more than 25. It has to be much bigger than 25 for us to clock the $1 billion sales. And our EBITDA margins, as I mentioned at the beginning of our call, so we will move closer to 30% EBITDA margins. So, and our return ratios also will move closer to 30. Because of investments, what we did in FY22 came into use only just now from this quarter. So, ratios also will improve.
Okay, got it. A couple of business questions. I don't know how much you can talk and how much you can't, but I'm inclined to ask you. One, a lot of conversation around how Russia's pain in Europe could be India's gain, and some Indian companies, including some people say Laurus, are well positioned to be able to capture some market share for medicines going into Russia and for medicines going into Europe as well. I don't think too much medicine supply from Russia happened to Europe, but I may be wrong. I would love to understand your thoughts here, sir, of the landscape overall, and then for Laurus as well, individually.
See, the current geopolitical crisis, we don't have a basket of hundreds of products in Europe and US. So our business will be, we do believe as usual, will not be influenced negatively or significantly positively by this geopolitical crisis. We don't have any approvals in Russia, so we don't have any opportunity to sell into Russia. The other is we have only 3 products launched in Europe, although we have 8 approvals. We have only 3 products launched. We are seeing good demand for those 3. And most of the other companies in those portfolio, Indian companies, so others will also gain advantage if there is a higher opportunity. When it comes to US, again, we don't have a big basket. So our sales growth in Europe and US not influenced or we get a bigger share because of this crisis. I don't think so.
Great. Thank you for laying it out, Dr. Chava. Now, a couple of other things. I don't know how much you can talk about it, but would love to understand from you. This global life sciences order, or any major order actually, including this global life sciences order that you commence supply in March, if I'm not wrong. Can you talk a bit about this? Some color about how would this or some of the other large orders ramp up in FY23?
So we're able to capture the attention of big pharma because of our capacities, because of our regulatory track record, because of our ability to deliver large-scale volume. So we got opportunity to work with one of the big pharma, which we have a small relationship. That business relationship was expanded significantly. And we started supplies in March, and we continue to supply in current quarter and future quarters also.
Okay. Any thoughts on what could the numbers look like, or you may not be able to talk about that?
We're not able to talk about the numbers or the product or the company because of the confidential issues. But we are on track to deliver what we committed to deliver.
Okay. I heard you in another interaction that you didn't think Paxlovid was as big an opportunity. That the world is very, very different in that while we think that we are out of the pandemic, so to say, it keeps on coming back. By the time you are on stream with that opportunity, could it become material, or is it difficult to say?
See, we also got license from Pfizer through medicine patent pool along with several others. We are in the development phase, and we're not going to complete the development in this part. If at all we complete and we get an opportunity to be Q2 launch, but I don't see the opportunity is going to be bigger.
Okay. For Laurus Bio, one question there. Impressive run-up, but albeit on a very low base, as you would also agree. Now, you said that you're gradually ramping up this 180 KL fermentation capacity for large-scale CDMO partners, and that full benefit will be expected in the quarters ahead. My question is, how soon and what percentage can Laurus Bio be from the current 2% in FY23, or is it too soon to expect that to make a material contribution?
See, currently, the Laurus Bio, we moved from 20,000 liters to almost 200,000 liter fermentation capacity. We still doing some debottlenecking of 200,000 liter fermentation capacity by adding some downstream, upstream. And major capacity expansion will happen in FY24. And significant jump in revenues and profitability will only come in FY20. So FY23-24, from 100 crores, still we grow because of debottlenecking what we're doing. We also wanted to offer research as a service, not product as a service. So some improvement will be there in numbers, but significant numbers improvement will be seen only in 25.
So FY25, Laurus Bio does significant improvement in numbers. Custom synthesis moves up from 19% to 25%. And all the other divisions also continue to grow. Their contributions could, of course, get altered accordingly. Fair assessment, right? Simple math.
Yeah, right. Even if you look at our FY22 numbers, we are at 40-40-20. So 40% generics, 40% APIs, 40% formulations, and almost 40%, 39, and about 20% CDMO. Both I added both CDMO of small molecules and large molecules. We're at there. So when we gave guidance by FY25, we wanted to go to 25% CDMO contribution. I think we'll get there. We'll get there. Maybe a little more than what we anticipated. Without considering bio. So bio will also contribute a good number in FY25, but not before.
Not meaningful as yet. Okay, fair call. Last couple of questions, Dr. Chava, before we let you go. So you've now reiterated umpteen number of times that it's $1 billion guidance. I'm not going to get there, but for the fact that in order to reach that $1 billion, you need to grow top line to the tune of about 50% odd. And my added question to that would be that what would you do on the PAT margins front, if you can maybe spare a thought there? Because if you were to return to FY21 PAT margins, and I'm not saying you will, I'm asking you, that if you were to return to FY21 PAT margins, your bottom line will grow by 72% in FY23 over FY22 with a 50% growth in top line. Do you return to FY21 PAT margins, or you're not really focused as much out there?
We don't want to dwell too much here, but again, we gave two important guidances, and we are reiterating those. One is $1 billion in sales, and our EBITDA margin closer to 30%. I think I will not dwell more than that. So it is very easy to draw further numbers. So we don't want to give more flavor there.
Okay, and I'm guessing the strong exit in Q4 kind of aids the momentum into Q1 itself as well, Dr. Chava?
Yes. So we foresee good Q1 as well. If we don't do Q1 onwards to contribute to our goal, otherwise we will have to do significant large numbers in Q2, Q3, Q4. So Q1 will also be good.
No, I'll end this interview with one thing, Dr. Chava. Your confidence shows, but I'm sure that in a scenario like this, it is very difficult for most companies to be able to predict or give very strong guidance. I mean, companies with even higher visibility are giving ranges and not necessarily sticking to a number. So I'm sure that investors will be considerate of that. But it's interesting to see that you're pretty confident about what seems to be a fairly strong growth here in FY23. You continue to believe that the step-up here stays in play despite all the uncertainties on the macro front on the Western world and in continental Europe because of what's happening in their conflict.
See, here in pharma, the success will come from the hard work done 2-3 years before the results come. Whereas failure can come pretty fast. So we put a lot of efforts. FY22, although our numbers is not significant growth, but we have done a lot of base work, a lot of preparation for our growth. So we have developed more products, we have added more clients, We created more capacities. We got more approvals. So our hard work of FY21-22 will benefit. See, otherwise, when the Q1 of FY23, if we say we have to develop a product, create a capacity, get approval, it will take 2 years. So our confidence is based on our work done in FY21 and FY20.
Very good. Dr. Chava, we wish you all the best for that. Thanks so much for taking the time out and speaking to us today, and have a great FY23.
Thank you. Thank you. Thanks.
Thank you for being with us today, and viewers, thanks for tuning in.